When we talk about markets at the moment, the first thought goes to the US, which is a dominant and the largest market. And the US is still got a lot of problems. The main one really is the presidential election coming up, because the two candidates have got totally divergent views and will lead to totally different policies. So that creates uncertainty. Having said that, the US economy is still expanding and still growing, and in fact it's close to capacity. So underlying the big problem is, has this cycle been going on for too long? You can see that in the unemployment rate, which is at record lows. So for investors, the problem is there enough momentum and strength behind this recovery that's taking place that will enable the economic growth in the US to continue for another 1 or 2 years? Or are we reaching a point where the Fed won't be able to hike interest rates because the cycle is unraveling? And that's where the presidential election comes in, because that causes uncertainty just when you don't need it. If you go to Europe, then Europe is still trapped in a mess of bureaucracy and political uncertainty. And the upcoming elections and referendums in Italy and Germany and France don't help there at all. And the bureaucracy and the inability to make decisions also regarding the Italian banking problems and now the Deutsche Bank problems just both highlight what's happening, the inability to really make decisions and the structural problems within Europe, and also the uncertainty going forward. So you're not really attracting new investment in Europe. If we go to emerging markets, then having described to you what's happening in Europe and US, you can understand why a lot of money is flowing to emerging markets. Emerging markets, the currencies from 2012 to 15 fell significantly, so they are undervalued in that regard. And structurally, they've got much stronger growth rates, and that's really because of strong banking systems, growth-oriented policies, and still a lot of dynamic policy making by the government. So, and you can see how emerging markets have started to outperform. When you look at our portfolios in terms of what we have done, we always believe bottom-up is much better than macro-driven. Macro policies are difficult to forecast, so we focus on individual companies. Having said that, we do find that in the financial sector we find the best value simply because it's unloved. People have all fled the sector and emerging markets. And as an example, our financial fund year to date is 10% up, which is actually outperformed the MSCI World, and our emerging market fund is up 30% year to date. So it does show that by focusing on what is unloved and companies in there will add value and to a certain extent be macro aware, but focus on the companies.